Imagine this. You open your trading platform, you've got your analysis all set, but suddenly the market makes a small move, just a few ticks up or down. Now, if you're a beginner, you might think, how much does that really matter? Well, here's the catch. That tiny move, that single price change, could mean the difference between a winning or losing trade, and it all comes down to one tiny thing: the pipe. Now, if you're scratching your head and wondering, what exactly is a pip? Or maybe you've been trading for a while, but still don't fully understand how pips impact your profits or losses, this video is for you. By the end of this, you'll have the tools to predict how pips affect your trades and start making smarter, more informed decisions. Stay tuned, because in the next few minutes we're breaking down the mystery of pips, and I'm going to show you exactly how this small detail can turn your trading game from good to great. Alright, let's start with the basics. You may have heard the term pip thrown around a lot, but what exactly is it? Well, a pip stands for percentage in point, or price interest point. But let's break that down even further. A pip is the smallest price movement in the value of a currency pair. When you're trading Forex, you're always dealing with currency pairs. Think of something like Euro/USD, GBP/USD, or USD/JPY. Each of these currency pairs has a price, and when that price changes, it moves in increments. A pip is generally the smallest of those increments. Here's where it gets interesting. In most currency pairs, the price is quoted to 4 decimal places. So for example, Euro/USD might be priced at 1 down, and the last digit, the 0 in this case, is the pipe. If the price moves from 1 bounce, but, and here's a big but, not all currency pairs are quoted the same way. For currency pairs that involve the Japanese yen, such as USD/JPY, the pip is actually the second decimal place. So, if USD/JPY moves from 150 to 150 to 105, that's a 1 pip move. Why does this matter? Well, the amount a pip is worth depends on the currency pair you're trading. For most pairs, it's calculated to the 4th decimal place. But for yen pairs, it's calculated to the 2nd decimal place. So, now that we know what a pip is, let's talk about how to calculate its value, because this is where it gets real. Here's the deal: understanding how to calculate a pip's value is essential if you want to effectively manage risk in Forex trading. So let's break it down step by step. The pip value depends on 2 things: the currency pair you're trading, the size of your position, the number of lots you're trading. Let's start with the currency pair. For most pairs, like Euro/USD or GBP/USD, the pip value is going to be based on the base currency. That's the first currency in the pair. In the case of Euro/USD, the base currency is the euro, but in some cases like USD/JPY, the base currency is the US dollar. Now let's talk about position size. A standard lot in Forex is 100 units of the base currency. If you're trading one standard lot of EU or /USD, the value of each pipe is typically $10. So if EU or /USD moves 50 pips, your profit or loss would be 50 pips x $10 per pip. What if you're trading a smaller position? Maybe you don't want to trade 100,000 units. You might go for a mini lot or a micro lot. A mini lot is 10,000 units of currency, and each pip is worth $1. A micro lot is 1,000 units, and each pip is worth 10 cents. So if Euro/USD moves 50 pips, your profit or loss on a mini lot would be $50, and on a micro lot, it would be $5. This is why it's crucial to understand pip values. When you're placing trades, especially if you're using leverage, you need to know how much each pip is worth. The more you know about pip values, the better you can manage your risk and control how much you stand to win or lose. Why pips matter in Forex? You might still be asking, okay, so pips are important, but why should I care? Well, here's why pips are absolutely critical for your trading success. Pips determine your profit and loss. So whether the market moves in your favor or against you, understanding pips allows you to calculate how much you stand to win or lose. And the more accurately you can calculate this, the better you'll be at managing your risk. This is where things start to get really interesting. In Forex trading, risk management is everything. It's not just about predicting whether the market will go up or down, it's about protecting your capital and minimizing losses. And pips are one of the key tools you can use to do this. You've heard of stop loss and take profit orders, right? Well, setting these orders effectively requires you to think in pips. Let's say you want to place a stop loss order 50 pips below your entry price. If the market moves 50 pips against you, your stop loss will trigger and close the trade, protecting your account from a larger loss. Now, let's talk about leverage. Leverage allows you to control a larger position with less capital, but it also amplifies both your potential profits and your potential losses. So, let's say you're using 100-to-1 leverage. With just $1,000 in your account, you can control a $100,000 position in the market. This means that each pipe movement is worth $10, but because you're using leverage, a 100 pipe move could result in a $1,000 gain or $1,000 loss. Understanding how pips interact with leverage is a critical part of risk management, especially if you're using higher levels of leverage. So, here's the bottom line. Even though pips are the smallest movements in the Forex market, they have an outsized impact on your profits and losses. If you truly want to master Forex, you need to understand how pips work, how they're calculated, and how they relate to your overall risk and reward. The more you understand pips, the better you'll be at controlling your risk, making smarter trading decisions, and ultimately becoming more successful in Forex. The market moves in pips, and if you know how to track those movements, you can turn small changes into big profits. Before we wrap up, I've got one more thing for you. If you want to become a better trader, start thinking in pips every time you place a trade. The more familiar you get with how pips affect your trades, the easier it will be to predict the outcome of your positions and adjust your strategy accordingly. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more tips and strategies to improve your Forex trading. Thanks for watching.